Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets for August 2022. In order to freshen up the format a little bit, I've invited Luke Mandekic along from Channel Capital to ask a few questions to try and make sense of some of these major issues which markets are facing. We've had some very large market moves over the June, July, August period. So Luke, thanks for coming along, and hopefully you've got some questions that'll tease out some good content for our investors.
Thanks, Charlie. So if we wind the clock back a couple of months, sort of as the Northern Hemisphere was heading into that summer break period, it felt as though the market had almost reached a point of peak recession fear. A lot of the data since then has been quite positive though, with consumer confidence rebounding, labour markets fairly strong, and a fairly positive corporate reporting season. What's your take on how things are? Do you think we're still headed towards recession at this point, or perhaps already in a recession, as some economists have been suggesting?
Yeah, so we'll take it from the point of view of the US, I guess, as the major economy which everybody faces. The US are already in a technical recession, albeit very, very slight. But you're right, the data's been holding on a lot better than we might have estimated. I think with the continual application of the brake pedal, though, in terms of higher funding rates, it's very likely that the data continues to decay. So as much as consumer confidence had come off very extreme levels, certainly market pricing had come off very extreme levels. We saw shocking performance in equities and corporate credit markets into that June period in particular, May and June. We've had some relief rally over the summer, and there was some hope that there could be more of a Fed pivot, I guess, that could be delivered. But no, I think it's very likely that almost certainly we're going to have a pretty substantial recession out of Europe. They're facing intense energy problems at the moment, which are really only going to get worse as winter kicks in. As we said, we're expecting the economic data to continue to decay in the United States. All of the forward-looking data in terms of new orders and PMIs have continued to be pretty weak, while some of the lagging data like employment has been holding on okay. Inflation has been turning a little bit. We did have a 0 month-on-month inflation reading for the July month. We're going to get the August data shortly, and it's probably expected to be almost negative. We've had a big drawdown in used car prices, and of course continued moderation in oil prices, somewhat politically delivered, but we'll no doubt talk about that in a moment. But no, I think that the central bankers seem intent on continuing to hike to complete this work to crush inflation expectations, and so it's remaining difficult for markets whilst they're in that process of policy withdrawal.
Yeah, and so you mentioned the Fed pivot in there. That's certainly been, I think, a significant part of the equity market rally that we saw coming into that summer period. But the messaging coming out of Jackson Hole was that the Fed's sticking to their guns. No pause in sight at this point. Predictably, equity markets tanked on the back of that. But interestingly, bond markets, in particular long end yields, have also sold off. What's your take on the bond market reaction?
So long end yields have sold off in response to a huge rally that they had enjoyed earlier in the back part of June and the early part of July. Look, whilst the Fed is still hiking interest rates, bond yields are going to be kind of pushing up. The vast majority of the sell-off from such low yields is certainly now behind us. But you're right, the Federal Reserve are intent on continuing to keep hiking. And this pivot we've been talking to investors about for a while, the safety net is a lot further below the market this time. And we've got to think that through with regard to capital price destruction and some of these assets that had really V-shaped kind of outcomes in 2020 and 2018. It's just not likely to be easily realised in that way, because regardless of where we get to, if this happens in shorter timeframes, inflation is still going to be way over mandate as a result of some of these massive geopolitical shifts that have been occurring in and around the energy story, some labour shortage which still seems to be hanging around post this kind of COVID environment. And so there are these higher structural inflation expectations that we probably have to get used to without obliterating demand altogether. And so certainly the idea here is to destroy demand enough to take pressure off parts of the economy that are under supply constraint and bring things back more into equilibrium. And we know how successful that can be. I mean, if you think about energy, for instance, if in the GFC we went from $140 a barrel of oil to $40 in a few months, if you really scare economies enough, then those consumption numbers start to come down really, really dramatically. And clearly, in something like the energy markets where there's huge volatility and speculation all the time anyways, that can have a really powerful effect. So we do think that the Fed are intent on continuing to hike. We don't think they'll turn around and support markets as easily, and that's clearly very difficult to do if we're still under higher inflation readings. So the days of material rate cuts and QE are probably some ways away, and a lot of asset markets are going to have to stand on their own 2 feet independently for a little while longer. And that probably means that we have a much more kind of historical default cycle in front of us, where we can't paper crack over every problem immediately by generating and delivering excess liquidity and very low rates again to make all those problems go away. So that's something that investors need to think through.
Okay, so while the Fed continues to sort of tighten monetary policy, there's also been some almost counterbalancing fiscal measures that have been put in place. One of the more interesting ones was Joe Biden's recently announced student loan forgiveness program, estimated cost of north of $400 billion. I think Larry Summers characterised this as a measure that would likely increase demand and increase inflation. How do you think? Do you think this is a meaningful policy step and something to be worried about?
I think at the margin he's absolutely correct. It is slightly inflationary. It's like the Inflation Reduction Act. I mean, it looks like fiscal spending to me, which is not going to slow inflation materially. It is important to remember, yes, $400 billion delivered over 10 years. The quantums sound really large, but in the context of the US economy, it's not as big a number as it sounds in terms of a notional. So yeah, I think at the margin it is somewhat. Obviously, there's a lot of politics involved in this, and Biden went to the polls promising that he would deliver on this, and ahead of the midterms he needs to tick some of these kind of political promises off. So yeah, on one hand you've got the Fed certainly taking away as quickly as they can, and Biden giving with the other, and certainly Biden's overstimulus of the economy via the multiple fiscal rounds in 21 has generated a lot of this inflation, in combination with ridiculous monetary policy settings left in place for too long after the COVID issue. And now we're dealing with the aftermath of that. But I think that's as much a political play as anything. And yeah, you certainly could characterise it as slightly inflationary, but it's not the real crux of where the inflation's coming from.
Okay. And so another controversial policy of the Biden administration has been the release of some hundreds of millions of barrels of oil from the Strategic Petroleum Reserve. I suppose it's likely that that's had some dampening effect on energy prices in the shorter term, but longer term, those supplies will need to be rebuilt, potentially creating some artificial excess demand for oil. Does this have some future implications for inflation, given just how pervasive oil is as an input into supply chains?
Yeah, it's a great question. 90% of that reduction of inflation that we got from the July numbers delivered in August were energy related. You're right, Biden has been drawing from the strategic reserve since March, when Russia-Ukraine broke out and oil spiked up to $130 a barrel. Today we're about 85, so it's drawn down materially. He is under mandate to replace that oil. So there must be a time at which the US government become a price inelastic buyer of energy. Now you've got to hope that there is a master strategy at play here, because as we might expect, the political chess pieces will move. It's pretty likely that Russia, to solidify its own negotiating position, will freeze Europe with the supply of gas and oil that will be moved to other parts of the world come the winter months. And should the US government go onto the open market and start to buy oil in the quantums that they have been flooding the market with over the last 5 or 6 months, then certainly we've got to expect oil prices can come up pretty materially. There will be a lot of speculation in and around that, and the counterbalancing effect is how much demand gets destroyed via the rate hikes that are again taking away with one hand whilst we've got to re-gift with the other. There are some positives in this story. The US rig counts, the Baker Hughes rig counts have been consistently climbing. Now you've got to remember that in the energy space, A lot of the capital expenditure was destroyed in the last cycle for a number of years. These corporations have been told that they are in yesterday's industry and carbon will not exist, and we're all moving to green and sustainable energy systems. So there just hasn't been the investment to generate capacity quickly. Having said that, there is a huge movement now to counteract some of these global and geopolitical forces. We're seeing that the re-fracking potentially of gas on the European continent. Some of these nuclear reactors, which were listed for decommissioning, are going to be repurposed to stay open a little whiles longer to try and bridge this supply interruption phase. So yeah, we are worried about that. I guess, as we said, if demand destruction is acute, then energy prices will fall quickly and materially. But if they've got an inelastic buyer operating at the same time, there can be a lot of volatility and speculation as a result of that.
Okay, so energy markets more broadly clearly been a huge part of the inflation dynamic and the ructions across the economy more broadly over the last year or two. Can you just talk through how you're thinking through some of the potential scenarios ahead of us and how the supply and demand dynamics may play out in energy markets and the filter through to the economy?
Yeah, so we think about these scenarios. Let's say that's, just to keep things simple, let's say there's 5 scenarios. So there's a central scenario, which is most probable or expected, maybe 2 other scenarios, one good for risk assets, one not so good, which are quite possible, and then maybe some extremes on those tails. We'll start with the central scenario, which is the one that's broadly priced by markets, that energy will find a new range in this disjointed world where there's a bit of take with one hand and give with the other, but we have carved out a range that's roughly been kind of $80 to $120 a barrel of oil. You've probably heard me say all year that it's the rate of change in inflation that matters. So if energy goes from $40 a barrel to 80, 100% increase, 80 to 120, 50% increase. If it just flatlines at 120, becomes a 0% increase. And so this is a really important swing factor in the in the inflation setup. We've already seen goods inflation really moderate very quickly now. Used cars and some of these other things coming off very quickly. We know global supply chains are healing. Delivery times are dropping, freight rates are falling, all of these types of things on the goods side. On the services side, the inflation is much stickier, and some of it is legally contracted. So things like rent, which goes up by CPI. If CPI has previously been very high, then you're allowed to move your rent up by that higher amount. So this is why we've got to attack these headline CPI levels to stop that becoming a self-reinforcing mechanism that then pushes wage expectations up and obviously the whole cycle and that loop of inflation expectation starts to grow. So this is where the Fed are desperately trying to destroy that demand. So in that kind of scenario, which I guess is central, we're expecting Fed funds goes up to about 3.9 or close to 4%. As at today, we're at, let's say, 2.5 with the expectation of a pretty big rate hike, potentially 75 basis points in the month of September, and then probably slows down a little bit. Equity markets, I guess broadly at the moment, are okay with that. We're well off the lows, we're well off the highs, but we're in the middle of that range. But as we said, it's likely that they're going to stay at higher rates for a time period. And that's important because delinquency requires 2 things. It requires high prices for those that are indebted. Well, we're going to get those, but it also requires time. So if you've only got to make one high interest payment, well, that's inconvenient. If you have to make a consistent series of, or you need to refinance a lot of debt that you've borrowed at much lower rates, at much higher rates, that's when it becomes really problematic. And that's when we get those blockages. So that's our kind of central scenario, that the Fed doesn't have to go too much further. I guess the bond markets, from our point of view, have already made huge adjustments to deliver those outcomes. So that's what's currently priced. And we will find a range before the bond markets might get excited if there would be stimulus delivered to the economy if we get maybe a step too far in this. But we do need to see inflation expectations come down consistently. And I think the expectation at the central scenario is that they continue to moderate to kind of 5 or 6 into next year before then falling again pretty materially into 2024. Assuming that we don't achieve those inflation outcomes for whatever reason, there's politics or there's exogenous shocks that generate more energy price increases, that becomes really problematic for central bankers. If they're going to be true to their inflation mandates, have to continue hiking really aggressively. That's clearly very bad for most assets. It's not great for bonds, but I dare say it's probably worse for other assets that we know can sell off very, very violently and very quickly. We saw that in May and June, where a lot of things played catch up to the bond market and then overshot in some regards. And so then, we're talking about Fed funds going up to, 4.5% or 5%, and that really becomes incredibly chaotic for particularly low quality corporate credit borrowers and a lot of, weak, growthy type assets that would be repriced very violently. So that's the negative and possible. The other one that's possible is that inflation does moderate and for whatever reason we can find a pathway through and it comes down a little faster than we're expected. And then clearly central banks don't have to take away the punch bowl as much as markets might have expected. And in that scenario, we would see all assets gently performing. Obviously bonds would do fine, but other assets would probably enjoy better returns. Obviously each asset class, differing risks, differing return expectations. And then on the tails, and this is what's such a complex year because the tails can actually happen concurrently. Let's say that one tail is a peaceful resolution of Russia-Ukraine and global energy markets can come back into balance and the supply of cheap energy can be re-established. Well, clearly risk markets are going to love that. Inflation expectations would come down a lot. Bonds will do great, but you probably want to be in high growth equities and crypto and all these other things which will do much better. Or on the other side, we have a US-China problem in Taiwan or a more hot conflict. And then we'd be really worried about risk market performance in that kind of environment. Again, it could be very inflationary. Initially, we would expect bonds to do very well in some kind of flight to quality moment. But as we've seen from Russia-Ukraine, once the inflation expectation comes, it might not persist. So in those scenarios, if we say there's 5 plausible scenarios of differing probabilities, we kind of see bonds doing pretty well in 4 out of the 5 in a portfolio context. They play their role. They might not be the greatest performing part of the portfolio, but they are playing their position, within the team. Obviously, if we get a full resolution to all the geopolitical conflict and nastiness that's been occurring, well, then you might not need them, like your insurance contract when your house doesn't burn down. They've still got a role in there to play, I guess, but you should be allocated in other things. So, yeah, I think that's a reasonable way to think about things. This energy componentry is such a powerful swing factor in this. And clearly, those handles are controlled by, Biden, by Putin, by Xi, by OPEC. There are very few folks that can really pull the levers as to where that will land. And we certainly can't predict that with any kind of certainty. And on top of that, you've got a very volatile energy marketplace with intense speculation. So we have to expect that there is volatility in those energy prices into year end again.
Okay, so you mentioned your base case expectation for the Fed funds to peak at around 4%. I think the euro-dollar futures market currently has Fed funds peaking at about 4% early next year before rate cuts are expected around Q3 next year. Interestingly though, prior to Jackson Hole, I think the market was pricing a shallower peak in the Fed funds rate and rate cuts earlier in the year next year. So, I mean, the curve is still inverted and, it's still pricing a fairly difficult outcome next year, but perhaps less so. I'm wondering if there's maybe an early warning sign in here that maybe the market has become a little bit too carried away with pricing a recession, and maybe that sort of elusive soft landing has maybe been underpriced by the market and is potentially a bigger risk for some asset prices.
Yeah, I think that I don't disagree. I think we've priced out a lot of the potential rate cuts whilst lifting the terminal rate expectation up. Part of the problem for markets is that equities rebounded so strongly off the lows in June that we got back to just a few weeks prior to Jackson Hole. The equity markets were at valuations at the same level as they were before the first rate hike. Now, the rate hikes are supposed to impact financial conditions. They're supposed to stop us from going out and spending in the economy and therefore We take our demand out of the economy and we bring the economy back into a better equilibrium without excess demand and these things. So look, I think that the expectation that we can have this soft landing, I personally think that the fastest rate hiking cycle we've had since '94 on the largest debt burdens we've really ever had is going to have a hell of effect. And there is a big lag effect from these things. Now, it's less obvious in the US markets. The transmission mechanism there is actually quite slight because most people have a 30-year fixed mortgage. And so if you're lucky enough to have 3% money for 30 years and the prevailing price of money is at 6%, who cares? You're all locked in at 3%, happy days. Clearly in Australia, that's not the case. We have about an 80% transmission mechanism via the RBA cash rate, and we've just had an intense series of rate hikes after being promised that that wouldn't transpire until at least 2024. So the expectation here was that there was safety in borrowing money, borrowing large amounts of money. We've certainly seen asset markets, particularly property, really run hard on that expectation. And now it's turning over at a very rapid rate, and it's only going to continue to occur as these rate hikes continue to be delivered. Just in the way that the rate calculations are actually hitting people's accounts, you're probably not seeing a material lift in those repayments yet, but they are absolutely coming. There's normally a 2 to 3 month lag with banks actually going through their own financial systems to push through those higher pieces. CBA Economics did a really good piece on that this week. But we do know, from history that 6 to 12 months' time, the rubber hits the road on those monetary decisions, and we've had the most violent movements we've seen since '94. So we have to expect that there is a material recalibration. It is simply illogical to think that there is more money in the economy when everyone is paying more for their debt. So there will be less spending. It will impact the economy. So we have to expect that it continues to slow. That soft landing, I personally think that we've probably already come too far, but we're in this perfect eye of the storm because we've done this all so quickly that the counter effect is actually not obvious yet, but it is coming for us. So I do think that that is something to think through, particularly as central bankers are now being forced to double down. Europe in particular and the Bank of England have really lifted their hawkish rhetoric in terms of additional rate hikes to combat this energy crisis that they're facing. And central banks have generally been moving in unison as a collective. We haven't seen, that kind of divergence that we would otherwise expect. But we absolutely do believe that the RBA and the Federal Reserve to some degree will likely slow the pace of those rate hikes from here on after these September moves, whilst the ECB, who are so far behind the curve, have a lot of room to catch up on. Both the Fed and the RBA have suggested that their neutral rate is around 2.5. We're already there in the United States. We're at 2.35 today in Australia, so we're pretty much there after coming from 0.1. So this has been a big recalibration, and there should be a pause and assess moment to see the full effect of that on the economy. They can always hike again later on, but to continue and to go way too far would be to have to turn around and come back the other way. And that's what markets, I think, we're looking for, that there would be that easy pivot and that accommodation would then quickly be restored. I think it's had to think through the severity of this energy shock and the motivations of those that are manipulating it in some respects. And clearly this is looking like it's a long and drawn out process. And so offering that accommodation to the market could actually stimulate inflation just as it's coming down to where you would want it to get to and on a glide path to much lower outcomes. So that's why that Fed pivot is so much lower below the market than it has been in other cycles where we haven't had to deal with really driving the final nails into this inflation expectation monster that's been released by a series of exogenous shocks coming out of the overstimulus from the COVID period, meeting war in the Russia-Ukraine and generating that global energy shock and food shock to some degree, and then a whole series of Chinese lockdowns that we've had to deal with over the course of this year, further interrupting that supply chain and the normalisation of.
Okay, so hypothetically, if we do sort of continue on the current trajectory as this next series of rate hikes is delivered into the end of the year, and the Fed does manage to continue cooling inflation without crushing growth, do you expect that would have a material impact on the bond market? How do you think that sort of scenario would play out in markets more broadly?
Well, it's a really Goldilocks outcome that you're kind of suggesting. We have never really had a period like that where we've had rate hikes. Normally, what happens in these hiking cycles is they hike until something breaks in the economy or in the financial markets. In 2018, that was the corporate credit markets that seized up when we got to 2.5% Fed funds. Now that had happened slowly. There'd been the estimation that we would go much higher, and the markets didn't like that and had a tantrum. So far, we're really encouraged by the performance of the markets. As much as a lot of assets have been declining for most of the year, it's been pretty orderly and we haven't had those seizure moments, but that is something that we do worry about. But no, I think it's difficult to estimate that can occur without huge fiscal spending, which is counteracting the Fed's lifting of rates. And so that's an unusual combination that we don't often see working against each other. Certainly, Biden seems to have been working against the Fed to some degree over the course of this year, leading into these midterm elections in November in 2022. But no, I'd see that as a very low probability that we can continue to hike on very large debt burdens, taking discretionary income out of the economy and expecting that growth is unaffected.
Okay, so I just want to finish off with the final question on the domestic economy specifically. So if we look at the domestic yield curve, there's probably two things that spring to mind almost immediately. The first being the curve here remains quite steep, and we haven't seen that inversion yet. That's quite often a good precursor to a recession. Do you agree with the markets, seemingly the market predicting that it's sort of smooth sailing ahead for the local economy on that basis? And secondly, in the past, we've seen at the moment Australian bond yields trading at a fairly significant premium to the US counterparts, and that's despite the differences in inflation and labour market dynamics. What is it that's causing that divergence? Is it a result of RBA policy missteps, or was there something else going on there?
Yeah, I think it's the same thing as to why you haven't had a flatter term structure in Australia and to why Australian bonds are now trading so much cheaper than some of their global counterparts. Certainly the RBA's removal of yield curve control in October of 2021 was pretty disorderly in terms of a high calibre developed market central bank. It's a board enacted policy. If they're to change policy, it should be at the recommendation of the board. And we were told after the fact that policy was withdrawn at the discretion of the governor alone, which is a pretty big process fail. And obviously a lot of international investors got their fingers burnt, as did the domestic bond market in that process. Secondly, the changing of the forward guidance, which clearly is a ridiculous concept in such a complex world where there's so much water moving under the bridge. There are so many influences that can materially change the course of events. It's not a low in volatility and stable world like we might have had pre-COVID. There's clearly a lot of things going on at the moment. The forward guidance and the changing of those expectations, again, has not garnered international investors with a lot of confidence here. And some of the international investors that would otherwise invest here are motivated to absolutely not. And the major one being the Japanese, who are going through intense currency weakness at home, making foreign investment very, very expensive. On the back of all of that, we've got what we kind of term financial tourism. So all of a sudden, the world over, where domestic markets were somewhat uninvestable, and we're thinking here primarily Europe and in some respects Japan, because they were negative yielding bond markets, i.e. we will pay you to buy bonds, which is a strange concept in and of itself. There were a lot of folks that were drawn to high yielding markets, and Australia was a huge beneficiary of that. AAA rated, stable sovereign, politically pretty stable, very high rated, and we enjoyed huge participation in our market as a result of that. Now that yields the world over have risen, there's a lot of folks that just prefer to invest at home. And so again, they're not coming in and supporting us with that capital. We see that in the way that the currency is playing out. Currency today is at 67 cents. Given our own rate expectations, we would expect that it should be a little higher, but we're just not seeing that demand for Australian assets like we've seen previously. And of course, it doesn't help if the central bank is of low credibility or has got itself badly wrong-footed by misreading things. Now, we are sympathetic to some degree that the economic, jigsaw puzzle was thrown in the air by COVID and the pieces landed all over the place, and the data was incredibly violent. But to make these long-dated and singular promises has definitely shot themselves in the foot. So we do think that Australian bonds will continue to trade cheaper than certainly US Treasuries, which is the spread that's often referenced. I think that in this world of high volatility that everything needs to re-establish spread, and you've got to take out that peace dividend, if you will. And we're seeing that across multiple markets that are building risk premia, across every vertical. And we should expect that whilst the markets and the outlook remains uncertain, and this geopolitical kind of flare-ups can have big impacts. So I think that's the reason why we haven't got as flat a term structure. Certainly the longer end of the Australian market has lacked sponsorship. Certainly, we also had the RBA in there operating, buying a lot of those bonds as well. And so they've all stepped out at the same time, and obviously bonds have cheapened a lot as a result. But yeah, I think the RBA haven't covered themselves in glory, as is pretty widely recognised.
Well, thanks very much, Charlie. Some fantastic insights there, and look forward to chatting with you further as the year progresses.
Thanks a lot, Luke.